Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have David Dziekanski. He is CEO and CIO of Quantify Funds. Paul Marino, Chief Revenue Officer of Theme ETFs, as well as Ross Smith, Client Portfolio Manager with the Global Multi-Asset Team at Macquarie Asset Management. We're here to discuss tactical asset allocation and how to get exposure to key themes in the market, including gold, global defense, and banks. It's great to have all of you with us. Welcome to Trade Talks. David, let's kick this off with you. I think sometimes there's somewhat of a difference or a nuance between tactical and thematic. How do you perceive tactical asset allocation?
Of course. Well, first off, thank you so much for having us. I think thematic vehicles in the ETF space can be fantastic tools for use by tactical practitioners. They also can be used as allocation tools as well. I think we're seeing this really interesting phenomenon in the market right now where momentum has been the tactical allocation of choice for quite some time, but you're actually seeing, since April, retail get way ahead of the institutional world and almost leave the institutional world like scratching their heads. And I think that's one of the beauties of the ETF innovation is there's so many offerings, over 4,400 ETFs in the US, and it really gives retail the chances to be as lethal in their tactical trading as it would any institution on the world.
Yeah, and you also have a sports analogy as it relates to tactical asset allocation.
I don't have a sports analogy, but I could say that.
Oh, was that you?
Yeah, I think.
Oh, maybe I had it reversed. I'm sorry.
I always have a sports analogy.
No, yeah. So the way that we look at it is, everybody talks about the 60-40 model, the 80-20 model, and how there's a little bit of pieces that are broken to that, and we would agree. Sometimes those portfolios, while they're diversified, they're overly diversified, too broad, and you're not getting exposure to high conviction areas of growth in the marketplace. And so what we think is using thematics to hone in on those high growth areas of the marketplace is a way to enhance your asset allocation and your tactical strategies. You can do that tactically in an ETF wrapper, as you know, daily liquid. So when you want to get in, you get in, you add that exposure. If you grow soft on it, you reduce it, or maybe you switch and take another angle. So it's a way for clients of advisors and the retail investor to get specific targeted exposure to high growth areas.
Right. Okay. Now the sports analogy.
Roger Federer.
Yes.
Tennis, arguably considered one of the best men's singles players in history. If you look at all the championships he's won, he actually only won 55% of the points that he's ever played. And so we think of tactical asset allocation in a similar sense, in that you don't need to be right every single time, but you want to be right more than you're wrong. And if you do that repeatedly, that can produce great outcomes.
Yeah, well, predicting returns is difficult, right?
Predicting returns is difficult. And so part of what my team does with our investment process is, as opposed to trying to forecast returns, is difficult to do, right? I don't think we're going to be breaking headlines by saying that. So what we do is something called pairwise analysis. So rather than trying to do return forecasting, what we do is we'll pair up assets on a head-to-head basis and then just look to make a directional call on which asset we think will outperform, depending on the time horizon, let's say 3 to 6 months. So it keeps the process nice and simple, brings order and rigor to the investment process.
Let's talk about some of the themes here. And David, we'll kick it off with you. Bitcoin, gold, certainly the runs that they've had this year and the fundamentals behind that have made it intriguing.
Yeah, I think a lot of people see the price of Bitcoin and gold and think, oh my gosh, did I miss it? Is it over? We're in an environment right now where almost all asset classes are at their all-time highs in value, whether it's real estate or stocks. And I think the theme that we bring here is scarcity, right? I look at supply and demand. You can't always predict markets over the next 3 to 6 months, but you can predict supply. And both Bitcoin and gold have scarcity profiles that a lot of assets in this world just don't have. Bitcoin mines at less than 1% a year. 86 basis points of new Bitcoin is introduced to the world each year. Gold mines at 1.75% a year. A third of that is being purchased on an annual basis by central banks. If you look at the pace at which currencies are printing, they far surpass that. So whether you're looking at a short-term view or long-term, over the long run, it comes down to supply and demand. And that's where we see this vehicle. We have a stacked 100% Bitcoin, 100% gold ETF, ticker BTGD, and that offers a very good tactical tool for someone who wants to hedge against currency debasement.
Yeah. And what are the theme that you were looking at? I thought yours was quite interesting as well.
Yeah, so we look at where the money's going and where it's guaranteed to go, right? So one of the strategies that we're going to talk about today is the Transatlantic Defense ETF, NATO. NATO is the ticker symbol. And it is exactly what it says it is. We invest in both European and US defense companies that are in NATO territory, right? So NATO members. Think about what's going on in the world right now, right? So we have this visit from Vladimir Putin to Alaska. They want to go to peace talks. The administration has all of the NATO leaders in Washington, D.C. to talk about a path towards peace. What is that going to entail? That's going to entail European nations taking on a greater responsibility for their own defense, increasing their spending from 2% to 5% over the next 10 years. That's guaranteed. And they're going to take a lot of that into their own countries to help get the European defense manufacturers up to speed with where they are in the US. So for us, this is a diversified portfolio. Right. We know the spending is going to happen over the next 10 years, and it gives you exposure to the major companies in the US as well as in Europe. And for people that are looking, you know, just having a few defense names in a broad portfolio isn't going to give you the return stream that having a high conviction portfolio in defense will. I mean, this strategy is up more than 40% year to date, and we see it continuing to go.
Yeah, and I thought your strategy was interesting as well when you look at it in banks, you know, globally systemic important banks.
Yeah, I mean, we've certainly seen some of the financials and even some of the defensive names doing well this year, especially in Europe. Europe, in terms of global equity markets, being one of the best performers if you look at how equities have performed around the globe. If you look from a tactical standpoint, I think what's a top of mind for a lot of investors is on inflation. So we just had the recent CPI print, which sort of served, I think, as a Rorschach test, where if you're sort of in the inflation camp, you could see data points that would prove that you're right. But if you're in the deflation camp, you could see a lot of points that would prove to your right. I think what stood out to me with the latest print was regarding core CPI, which actually had one of its highest increases over the last 2 years. And so we see continued structural risks when it comes to inflation, not only in the medium term, especially a lot behind service inflation, but especially in the short term as we're starting to see potentially the effects of tariffs being passed on to consumers. So far we haven't really seen that. A lot of the tariff effects have been taken on by companies, but there's some indicators to suggest that can be passed on to consumers, and that could elevate inflation pressures short term.
Well, it's interesting because you also have to think about the AI and digitization efforts that are going into banking, which could also be part of the story as well. You can make the same argument with defense. Is it really a pure play? I'm sure there's something as it relates to the technology that can unlock additional value for the banks in this type of portfolio.
Yeah, and I think that gets to the sort of the point that that's top of mind for a lot of investors, which is regarding the growth versus value dynamic. Obviously, we've seen massive outperformance of growth, but what we've seen more recently is a bit of a broadening out of the market and some of the value names that have been coming into favor. We've seen more recently some of the tech companies softening some of their earnings, even NVIDIA recently causing some downward pressure on the market. So right now, yeah, what we do think is appearing attractive right now is some of the more value-oriented names, particularly because even though we've seen volatility come down post-Liberation Day, if you look at some of the expectations on future volatility, appears to be picking up. So therefore, we like some of the lower volatility, lower beta names that typically you get to access to in the value space.
Yeah, I would imagine too, going into the year, Europe was outperforming because of the valuation story. So, yeah. I mean, that's helpful to the portfolio as well when you're looking at these defense names. And then
on the defense side, you're right. So they took off. When Germany started to make commitments to defense and when NATO increased their spending amounts, absolutely they took off and the US lagged. But on this last news, you saw the US actually shoot up a little bit more than the European defense names, and some of those took a step back. I would add to what you just said, Ross, size matters, in any industry. And when you think about the financial services place that you were just talking about, that sector, like we think that the largest financial institutions have a distinct advantage. Like they have most of the deposits, they're less interest rate sensitive, they offer higher dividend yields. They're going to be the winners in the M&A movement and the consolidation that's going to happen in the financial system. So we think that, again, where you want to be matters more, like from a standpoint of how will organizations be able to take advantage of whatever comes, because we don't know.
Right.
Like the world is an interesting place. It's more interesting than ever. The administration is changing how they think and act in the world, and everybody's trying to respond to that. We think globally systemic important banks, the largest financial institutions in the world, are able to handle all those changes much better. They'll be part of all the investment that goes into, you know, the new paradigm in the world. And so our ETF GSIB gives you direct exposure to those 29 financial institutions. And again, we've seen really great performance because those are the types of institutions that could survive any kind of environment.
David, do you think the demand by investors to get exposure to alternative investments, if you will, and not just your traditional 60-40
Yeah, for
funds?
the first time ever, we were talking about this before the show. I think people are moving away from the use of ag in their benchmark. I think we just added so much debt to the global system that the idea of this being a stalwart in your portfolio as a defensive asset is no longer there. We see the inflation numbers coming up right now. I do think it's going to tail down a little bit. Tariffs are like a one-time jump in pricing, and I'm curious to see if we've really seen this pull forward effect of sales that a lot of economists are talking about. We're going to see a slowdown in the fourth quarter, but truthfully, the world is looking at us different, right? During April, when we had volatility, our stocks, bonds, and currency were all going down at the same time. That is normally only apparent in emerging economies, so the world is starting to reflect us as more of an emerging economy. So we have to get our house in order, but the other side of the coin is all assets in emerging economy can just blow up on the top, and so I think that's where the thematic ETFs come into play. There's so many areas of the market that have shrunk to such a small percentage of the S&P 500 because of the Mag 7, whether it's biotech or defense or like different pockets of growth. I think that's where, if this market rally is going to continue to rally, you're going to see those small subsectors that have been squished down to very small positions in the S&P 500 really drive the remainder of returns for the year. I just don't think a lot of that can still come from the S&P top 10, the NVIDIAs of the world. So if this market is to continue, and we kind of see it as a tale of two coins, like the top could totally blow off before there's anything.
I totally agree with that. And like I said earlier, but I'll expand on it a little bit, like for the first time in a long time, you know, the advisor is supposed to tell the client what to do and give them recommendations and act as their fiduciary. We're actually seeing the reverse start to happen. So on our team, our advisor team, like they're telling us that clients are coming to them and saying, I need more. Like I watch it on Nasdaq, I watch it on CNBC. I see that people are getting better returns because they have higher conviction, more concentrated portfolios in areas that are actually growing. So make me less diversified and more concentrated in those high growth areas. I can take the volatility. You know, volatility for a long time, because we talked about investments in retirement accounts, right? So can't take volatility, got to be a smooth ride. Why? Again, look at Bitcoin.
Yep.
It wasn't a smooth ride, but I bet you if you invested in Bitcoin 10 years ago, you're pretty happy with what you got today if you held on to it, even though it was up and down like this. Volatility has changed, and in a lot of ways, I look at volatility as a friend. It gives people an opportunity to get in at a better price point, and if you're interested in growth, you're probably going to have to put up with some volatility moving forward, but that's okay.
Yeah, and look at the generational opportunity that was afforded to us during COVID.
Yep.
Right? I mean, the rebound was remarkable. And it was check mark straight up. And, you know, if you're able to purchase these assets through your 401k or other retirement vehicles when they were much cheaper, that's exactly what you want to do, right? You want to get in and not get out, you know, at the bottom and buy at the top. So,
and if you got nervous and went to cash, you did nothing, right? But if you dollar cost average at the bottom, like, you know, just really like force yourself to be courageous and did it, you really made out very well.
Yeah. So when you think about how long these holdings should be within one's portfolio, or how do these fit into one's portfolio, and then when you're thinking about, you know, tactical allocations, how often should you be getting in and out of these?
Yeah, and I think to David's points, you know, the conversations that are happening between clients and advisors, sometimes it is prudent to have that shift for, you know, sometimes a client wants to be a bit more tactical, but it actually makes sense to be a bit more strategic. And so in the backdrop today, you know, the way we're seeing markets a little bit different today than we have seen historically, is that this is a time recently where we're seeing the dollar decline. And so investors are looking for ways to protect their purchasing power. And so with that, while we've seen inflation come down, one of the risks that we see in the market is that despite the fact that it can come down, there can still be surprises to the upside. So there can be unexpected inflation. So the question is okay, well, how do you get protection from purchasing power? And then how do you protect yourself where inflation may still surprise to the upside? So from that standpoint, an area that we find that's interesting and we see a lot of demand for investors is within what's called real assets. So things like infrastructure, natural resources, and then you can be selective within real estate as well.
So the advisors have to be well versed in terms of how these factors move and what's driving them, because I mean every portfolio has different goals in mind.
Yeah, no, exactly. I mean, advisors have to wear a lot of different hats, right? They're not just investment experts. They have to almost be psychologists, right? It's about keeping clients invested for the long term, ensuring that their long-term goals are aligned with their underlying investment exposures.
Right.
Definitely.
But some of these holdings could in fact be 3 to 6 months, or
they could be longer than that.
Yeah.
I mean, what I would say is do your due diligence and have high conviction in what you invest in. If you do your due diligence, you have high conviction in what you invest in, you're gonna be willing to take those ups and downs in the marketplace, knowing that you're gonna get to a better place. I mean, the great thing about ETFs is it's an unbelievable wrapper where you could take almost anything. We can go out in Times Square, grab a bunch of vendors, put an ETF together. I know, Jill, you got connections here. You'd have it listed tomorrow. We'd be launching that like ASAP. But my point is, maybe that's not the right thing to invest in. But if you've done your due diligence, you're like, think about it, AI. Are you convinced that AI is taking over the world? I am. That's something that I have high conviction in. Defense. I know that there's a path to spending trillions of dollars over the next 10 years in defense. I'm convinced about that. The banks, they're going to do well. The largest banks in the world are going to do well. Great. Bitcoin, gold, like all of these things, there's a place where the world is going. And if you have high conviction, get in them, stomach the volatility, take some Pepto-Bismol when you need to, and just, stick with it.
yeah. So these are actively managed funds for sure.
Mine are passive. GSIB is an actively managed one because we just manage it off of the globally systemically important bank index, which is 29 names. But our defense strategy is a passive strategy.
Yeah. So
TGD, which is a leveraged Bitcoin and gold, is actively managed, and we do a lot of those difficult trades, as he was alluding to, in the times of the heightened volatility in the market within the fund. And that's why we have less path dependency than traditional leverage ETFs. So it's a strategy called Portable Alpha. PIMCO had the first Portable Alpha fund in the 90s. So we take some of that onus away from the allocator. I think in terms of trends, I also like the marriage of crypto and Wall Street that we've seen over the last couple months. The Stablecoin Act, just JP Morgan released their own stablecoin. This really solidifies the level 1 players in the crypto space beyond just Bitcoin as a store of value, and really opens up the whole ecosystem. And if I'll add a caveat for gold that I think a lot of people don't think about is, a lot of people think about gold as a store of value. You hear the story of 100 years ago, the house was the same amount of gold bars that it is today. We think that actually really changed in 1971 when we went off the gold standard. Gold no longer was a store of value, but actually started showing real return attributes. So it became a source of wealth generation and not just a store of value. And that makes a lot of sense. We fully removed our linkage from the gold standard, and then all of a sudden it became a scarcity asset.
Yeah, well, it certainly makes a case for professional management within the ETF wrapper. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.